Hi everyone, welcome back. Today I'm going to be talking about our Reits valuation. It's basically very similar to a normal valuation. The only difference here is that we have Reits multiple valuation in which we use the AFFO, which is more reliable for rates. And once again, to conclude this spreadsheet, all we have to do is fill in the data in green, and I will be going over the full evaluation. But before I begin, if you like the spreadsheet, you can just go to my Patreon page. The link will be down below. Also, if you like the content, please hit the like button and subscribe. It would be much appreciated. So without any further ado, let's begin. So the first thing we have to do is put in the stock ticker symbol. I'm going to use Vici. And as you can see, a lot of data already loading in and already did. Now, the first thing we need to do is find the 10-year risk-free rate. So the link is over here. Okay, and we want the 10-year, okay, and it's 463. Okay, it's already plugged in. So the first valuation, we're going to go with a PE base valuation. PE is something very important to me in terms of valuating a company. So all the links though for the data that we need are right here. And the first one is the 5-year high that we need to come to macro trends. It's not loading in. Did. Okay, and now we want to plug in Vici. Okay, and now we want to go to price ratios, and right here P ratio, and we want the high, which is 2771. So we plug in 2771, and now we want the low. Okay, and the lowest point 1086, 1027, 1027. Okay, so we go in 1027. All right, and the average automatically changes. Now we need to put a growth rate. For the growth rate, you can make your own, or you can go with specialists. You can go to Yahoo. Let's go to Yahoo and see what they have to say. So we can come to financials. Okay, plug in Vici. Analysis and see what they have. They have a 630 growth. Okay, so we put in, let's give it a try on this one, 630. Okay, and we come to an intrinsic value of 32.10. Okay, so $32.10. That's the current intrinsic value. We also get a 10-year future intrinsic value. So within 10 years, this would be the price that it should reach. Now let's move on to the rates valuation, the multiples valuation. And for that, we need the AFFO. I have to put a link. I don't have a link over here. But for this, we need to go, we don't need to calculate it. All we have to do is go to, let's use alpha. Seeking alpha. Yep. Because they already have it here. So we don't have to do the calculations for it. We can just go to valuations. And right here. This is the one we want. The price to AFFO 12-month trailing. Okay, so 1342. 1342. Okay, now we need to find for these four, which is companies similar to Vici. So we're gonna go with FR. We can actually use this one, okay, because this was for O, And since I don't have O over here, we can use this for Vici. And so we come to an intrinsic value of 51.74. Okay, a little higher. And now we want to move on to the dividend discount payout ratio. Okay, so we want to go to Yahoo again, and we want to put in Vici, and we want to go to historical prices. Okay, we want 5 years and dividends only. Okay, so now we can see they're paying out per quarter. So since they're paying out per quarter, we do need to change this. Okay, I put a tag over here, say 12, because they pay every month, but that's because I did stag yesterday. Okay, I'm actually gonna put this green. Let's actually put it yellow, because you might need to change it. So the way you have to look at it is, if you see they're paying out per quarter, as you can see, the best way is if you go, let's say in December, the next time it was March, so you know they're paying out per quarter. You don't see January, February, so they're paying out per quarter. So what you have to do is take out the 12 and put a 4, okay, per quarter, and now just drag it. And now we want to put in the dividend payout. Okay, so per quarter we want to get these 4, and we want to put okay, we're going to use the calculator for this. So 0.41 and 0.39. Okay, since it's 3 at 39, we can just drag it down, and we can see it. We got a 0.40, so 0.40. It's our first one. All right, so now we have 39. Okay, this is going to come out to 37. So 37, year 3. Okay, this is going to come to 34. But if you want to make sure, you can always just use the calculator. Just plug in the 4 numbers, and the average will show up over here. Okay, now we want to use these right here, 2908. This is going to give us 30. So 30, and the last one is going to give us 28. Okay, so it had a growth of 9%, 935. The walk automatically comes in because we have it right here. So the intrinsic value is 38.64, and now we want to use the unlevered discount cash flow and dividend. No, sorry, we want to come to Yahoo. We're already on Yahoo, so we want to find the enterprise value. And the enterprise value is on statistics. Enterprise value right here, 4609. 609. And remember, since it's in billions, we need to add a 0. Just put numbers over here. Okay. And now we want the net debt. For that, we come to financials, balance sheet, and net debt right here. So we want to plug this number right here, 13,530. Okay. Yep, so we come to a negative 15. Okay, so when you get a negative, that means it's not a very appropriate method of finding the intrinsic value, and that will happen sometimes when evaluating stocks, especially Reits. So that's why over here we just take it out, and we're not going to be using unlevered. Okay, we take it out. And now for the last one, it's the discounted earnings valuation. And for that, all we have to do is get the growth rate. Okay, so the growth rate, we're going to use the same one as the, we can actually use this one or the analysis growth rate. I'm going to choose the analysis growth rate. It's a little shorter. 935 is a little too much. So I'm going to go with a 6%. Okay. And with a 6% growth rate, let me zoom in. With a 6% growth rate, we get an intrinsic value of $50. And we can see that in the next years, it should come to 75. Okay, and this is in a 6-year target. So as you can see, they actually kind of go in together. Let me show you. Go in together with a PE-based valuation. In the 10-year span, it gives us an 83. And the discounted earnings in a 6-year span gives us a 75. So you can see that it's pretty accurate when it comes to finding the intrinsic value with these valuations. Now the only thing left to do is these ratios, and which we're gonna do right now. So this is already data all plugged in. We don't have to do anything, and we come with dividend safety of 67.65. So that's not bad. That's actually pretty good. It means they're not in a position to cut dividends or miss dividend X dates and so on. Now what we want to find is the interest coverage ratio, and for that we need to find the EBIT and the interest expense. Okay, since we have it already in here, we'll just come here, and now we want the EBIT, and we want to put this number, just the first numbers, 3196, 3196, and now we want the interest expense, and the interest expense right here, 782. 782. All right, and the total comes to 4.9, and we come to a ratio, a good ratio. Okay, as you can see, if it wasn't good, it would just say bad. So okay, we're good on this one. Now the current ratio, we want to get the current assets and the current liabilities. Okay, so we want to come to balance sheet and current assets right here, and 17,856. Okay, and now the current liabilities. Current liabilities should be around here. So, yeah, right here. 593. 593. All right, and it comes to 30.90. This is actually pretty big. I don't know how accurate this could be. It's a little red flag for me. It's too high. So it's still showing up good. So I don't know if this is. It should be around a 5, 6, not give us such a big number, but it's on the good side. So we'll take it as a positive. Now we want to see the debt to equity ratio. This is one of the most important. This is going to tell us in bad years if they can sustain bad years in case if they have enough money to liquidate themselves in bad times. Okay, total debt 13,739. Sorry. 739. Now we want the shareholders' equity. I think this is on a different site. Yeah. All right. So we want to put Vici. We want to come to financials, balance sheet, shareholders' equity. Okay, so 22,290. 22,290. All right, and this is bad. Okay, so this just tells us that during bad times they won't be able to sustain for long. So if they go into a crisis, if it's for a long period, it could be bad. But I don't think they're in any danger at the moment. As you can see, they're actually growth. Yeah, yeah, they're pretty solid right now. So I don't think it's something to be very cautious about. And now for the last one, the free cash flow yield valuation. And for that, all we have to do is get the free cash flow. Okay, so what we want to do, we want to come to financials, cash flow, and we want to get this one, 2089. Okay, 2089, and the market cap automatically fills in. We don't need to do anything, and we come to a positive 7.2. Okay, so the ratio is good, and this is pretty good. The only one that comes in as a negative is the debt to equity ratio. This could be bad if they lose a lot of money in a short period, but I don't think they're in danger as of this moment. So now for the final valuation, when we just average down all the valuations from the metrics, and we come to a average output, the intrinsic value of 43.25. Okay, the current price is at 28.09, so we have an upside of 35%, a possible 35%. With a margin of safety, our acceptable buy price would be 34.60. So we are in the clear to buy, and this is the target the margin of safety. Okay, so if you want to have a 30% margin of safety, that's where we're at right now. It's at 30. Okay, it would be clear since the current price is at 28. If you want to 40%, you might want to hold and try to see if the price comes down to 25. It all depends on what they have in store for the future. And this is just a dollar cost average. Like I've said before, if you want to put let's say $1,000 into Vici, and you think the price is going to go a little lower, you don't want to, since you're already in the clear for 30%, might want to put just 40% of the total value that you want to put in. And then if it goes down, you put 35, and if it goes down again, you want to put 25. Okay, just to give you a way to dollar cost average into a position. Okay, I mean, all you have to do is change right here. If you want, let's say you want to put 1,500. As you can see, it automatically changed. This is how much you would have to put. And these are the target prices, okay? And this automatically fills in. Target 1 is at 34, so this is the acceptable buy price. It automatically fills in this price, which is at 20%. And then you have your second target, which is at 30%. And you have your third target at 25%, $25, which is 40%. This is you can change this as you like. And this is for my personal preference, and that's it. That's how you find the intrinsic value of a rate. And hope you liked it. And like I said, if you enjoyed it, please hit the like button and subscribe. It would be much appreciated. And tomorrow I'll be showing how to find the intrinsic value of banks. Okay, so see you next time.